I want to first let you understand why was there a need for a revenue recognition standard. So earlier also we used to recognize revenue, and as you would know that revenue is the biggest P&L item, right? There is so for this year, if you look at profitability, it starts from revenue, right? So the biggest P&L item is the credit of revenue. And what happened was, over a period of time, when people started understanding fraud, the accounting fraternity understood that what we have been doing till date is just, reactively responding to fraud that has already happened. And there were a couple of researchers who started researching on fraud, and they came up with a very interesting observation. They said that, see, in whenever there is fraud, and they looked at the history of fraud that has happened, and they said whenever there was fraud that has ever happened, the biggest area was revenue recognition. So what we said, so we said that, see, the biggest area of fraud is actually revenue recognition. And now we have proofs that in every case of fraud, the revenue recognition was a problem. That means either you have pre-booked revenue, either you have cooked your books and booked revenue when you should not have booked revenue, or you have not followed the measurement concept, you've overbooked your revenue. So inevitably, if somebody has to commit fraud, revenue recognition has to be an issue. You have not stated your P&L credit, the amount that should have been stated. So what we said, okay, now we'll deal with it twice. And I'll give you an example of two kinds of fraud. We'll first discuss Enron, and then we will discuss Satyam. We'll discuss both these cases. One is a very famous US case. And in fact, this was a case that led to the Sarbanes-Oxley Act and then a big overhaul in the entire concept of accounting. In fact, in the US, the SEC stopped believing that AICPA could handle everything on its own. So what they did, they actually opened another body and they called it Public Company Accounting Oversight Board. And they said that now we're not going to entrust AICPA to take the audit of all the issuers because we don't trust them enough. Because even after following everything that they said and having their auditors and doing everything, we realized that a lot of people, normal, common people, investors' money got spoiled because of the Enron fiasco. So a lot of changes. In fact, the entire accounting body in the US got rejected after the Enron fiasco. Again, there, a very, very geniusly engineered fraud. But we're going to talk about Enron, we're going to talk about Satyam. And I'll also tell you what happened post Enron. So the US started it, and then the entire world followed pace. And we said that no, we're not going to trust the accounting body itself. And also we realized that we have not yet objectively defined how revenue should be recognized. So this standard, which started with FASB, and then throughout the world, now we have a revenue recognition for Ind AS, for IFRS, for all the accounting bodies throughout the world. Also, what we said is now when the auditor goes and does the audit of any company, and this is what you will learn in audit, that there are two areas which are assumed as presumptive fraud risk areas. One is revenue recognition, and second is management override of control. So what we said, okay, whenever an auditor has to go and do the audit of any company, more so in a issuer, but any company, when you're doing the audit, you have to understand that there can be, so what you have to do now as an auditor, you just don't have to do the work. You will have to prove why revenue recognition has not been tampered with in this company. So you have to design audit procedures, assuming that the revenue that the company is showing you is incorrect, and then proving to the board or proving to anybody who is going to check your accounts and check the work that you've done in audit that the revenue recognition, why did you say that revenue recognition is okay? So we have to assume. So we are not saying that there is an element of doubt. We are saying for sure, I know that your revenue is wrong, and you devise your audit procedures to substantiate that the revenue is wrong. So we're presuming, so we call it presumptive fraud risk area. Presumptive fraud risk area. So we are saying that you're wrong. We are assuming that yes, there are internal controls which are very strong, but we are also assuming that there is a possibility that the management would override all of these controls to perpetrate fraud. So this is the premise. This is the outcome of what happened after all of that research was done. Also, there were a body of people who started researching on how to preemptively understand in the environment that a fraud can be committed. This is again something that you do in audit, but we realize that there are three factors. So if an auditor goes to a particular client, these are the three factors which, if he senses in the client, he could say that yes, there is a high chance or a probability that a fraud has been committed in this company. One is, and this a lot of people who've done accounts auditing would know. For those who've not done auditing, I would say that you please mark this area and call it a synergized area between audit and FAR. So we say pressure, opportunity, and rationalization. What do you mean by that? When you see that you go to a company and there's a lot of pressure on the management to perform good results because their bonuses are linked to that, then we say, okay, the company is creating a pressure cooker environment, and you would want the people might be instigated to commit fraud and overstate their revenue and understate their expenses in order to deal with the high profit margin pressures. There could also be very poor internal controls. In that case, there's a great opportunity for people to commit fraud. So opportunity is related with poor controls. So there were a lot of, maybe the cashier is also authorizing. So when you see a cashier also authorizing a payment, there's a possibility that you could authorize a payment and pocket that money on your own. And rationalization means there's a problem in the environment where a person who's committing fraud would rationalize that the company did wrong to me, so I'm rationalized in having a personal conflict of interest and making profit at the expense of the company. So a person who is doing wrong has in his mind or in her mind rationalized the wrong behavior. So all of this you'd be reading in audit, and why revenue recognition is such an important concept. Because what we've tried to do with this standard is we've told somebody that, see, we will not let you book revenue if these 5 steps have not been met. So it's like a sequential flow, and all the factors, all the points in those sequential flows, which are 5, has to be met before you could go and put a figure on the credit of your P&L account. So now, before I start with what is revenue recognition and what is the 5-step model, I'd just like to give you 2 examples of the nature of the fraud that was conducted, and you get an idea of how big can it be, because and they're very nice. You have very nice movies that talks about what had happened in Enron, but I'm giving you a very, very gist of a very small gist of what happened in Enron and what happened in Satyam. So see, Enron was typically into electricity and power distribution. And then there was a very, very ambitious CEO who would come in. And now what this guy did was actually a genius. What this guy did was, so he had a full team. And what he did was, he said, okay, see, we are into energy. And energy, all of these natural gas and everything, it takes a lot of time to discover. And the biggest problem was there are a lot of people who want the natural gas, and there are suppliers who would want to go and dig and keep looking for new areas and new reserves where the natural gas could be found. But the problem is that the suppliers need a lot of money, because it is like, just digging and not knowing whether you would be able to get the energy. So what this guy did, and what what Enron did at that point of time, they created an artificial product which never existed before. So what they did was, at one end they went to the suppliers, and at other end they went to the consumers. Their consumers were also industrial consumers, right? Industries who are wanting to have access to natural gas reserves, and these were people who were actually manufacturing the natural gas and the energy reserve. So what they did was, see, now you need a lot of money, right? And you not only need a lot of money, you also would want some surety that now the moment the reserve is dug and you are able to understand a new reserve, you would know that there are a lot of people who would be willing to pay for it. So what these guys did, they created a contract called volumetric production contract. Okay, so what is volumetric production? I'll just explain that to you. So what they did was, they said, okay, so just imagine the concept, okay? They said to all of these consumers, they said, see, these are the people who are ready to do the research, but they don't have the money. Why don't you do something? You give me money, and with that money, we will do the research and we will link your money to the area where the research was done. And in case if you get the natural gas from that area, we will allocate that production to you. So you would have paid in advance for your requirement of the gas. And the consumers liked it. And what they did, so they started, so what they did was actually, not at one individual level. They floated a lot of these SPVs, okay? A lot of these special purpose vehicles, as you call them, they were floated. And in each of these vehicles, they invested less than 50%. So when you go to consolidation, you will see that there's a possibility that if your ownership is less than 50%, you would be able to not consolidate that entity, but you would be able to book the profits out of that entity in your books. This is called an equity method of accounting. So I don't want you to confuse right now. When we do consolidation, we will do it in a much better way. But what I want to tell you is they floated a lot of these companies, and these companies weren't supposed to be consolidated in their books because what they devised the company in such a way that the ownership never exceeded 50%. And in the US, there's nothing called standalone statement. You only have consolidated statement. So all of these SPVs were out of the financial records. Nobody knew it. So what they did, they floated all of these SPVs and they created something like a mutual fund, where you could link one volume of natural gas to an instrument that you're holding, and that instrument you can trade in the market. Can you imagine how genius was it? Because the energy and natural gas was a completely physical market, and they converted it into a virtual market, and they also made it in such a way that you could trade on those small units that you would be holding. So somebody floated $1, that consumer paid $1, the supplier got $1, and with that $1 they are actually just digging, not realizing where is the natural gas, but the digging process has started. But that $1 has been circulated to probably 1,000 or even more dollars, because you have created one company who's having an investment. Now this company is investing in another company, and that another company is investing in another company. And eventually what these guys did, since they were taking equity method of accounting, somewhere or the other, they recognized revenue on the contracts which have not been finalized. Like, the natural gas has not been found, but it started recognizing revenue, and that revenue started getting and pouring in the parent company's book, because under the equity method of accounting, you could go and you could book revenue in your books, the profit in your books of a company in which you are investing less than 50%. So this entire thing was camouflaged. People were just assuming that Enron is making a lot of money because a lot of credit was coming into their books, but that credit was all bogus credit. No money was being generated, no cash flow was being generated. And that's the reason when the entire bubble got crashed, overnight the price of shares fell down, and a lot of people who had invested in Enron lost their money. So ultimately, the regulators realized that no, there are some loopholes both in the accounting standards, that is GAAP, that has been made out. And at the same time, so we were allowing pre-booking of revenue. There was no model in which we could catch hold and say that this is wrong revenue recognition. After this, it was a big thing. The entire auditors who audited Enron, Arthur Andersen and Company, they had to file for bankruptcy. And there were so many rigid changes that were brought about in the US, saying that no, we are not going to allow the accounting profession to handle. We came up with Sarbanes-Oxley Act. The idea of partner rotation came into picture, retention of records came into picture, audit committee came into picture. So the entire thing was rejected. And in that process came the idea of revenue recognition standard. You had to tell me when you can. So we processed the entire flow and we said, no, the problem is people are just booking revenues through Moto. We are not able to stop them from pre-booking revenue. So we came up with a model and said, you cannot pre-book the revenue. That was Enron. Okay. What happened in India? There was this company called Satyam, and the owner was Ramalinga Raju. And this guy has won numerous corporate governance awards, stating that this guy has been running his company very efficiently. And actually, the core business that Satyam ran is still profitable. Can you tell me which is the company that acquired Satyam? What is the new name of Satyam now? The company that acquired Satyam? Are you aware? Anybody from India? Are you aware? Tech Mahindra. So Tech Mahindra actually acquired Satyam. So what had happened with Satyam? It was a very, very successful company. These were the earlier front runners when you remember that Y2K, that model came up, and then the Indians started exporting the software. At that point of time, Satyam was actually into the software services that they were providing to US clients. And that business was really successful, even on the last day of the business, when the business was in really problematic situation. The order book for the main business was full. Now what Satyam did was, these guys got greedy. So what they did was, at the time, and this is around 2027 2007 2008, when that housing bubble happened in the US, right? So what was happening prior to that, Satyam as a company was very strong, and they had very close relation with the government in Hyderabad. So in that process, so much of money was being generated. At that point of time, I remember people, I was in Gurgaon at that point of time, and I still recall that, people were like, I invested 50 lakhs in a property. Within a year, it would become a crore, it would become 2 crores. The property market was just very, very heated. That point of time, what Satyam did was, Raju had two sons actually, and they floated another company and called it Midas, which is just Satyam spelled opposite. And what they did was, so Raju and his two sons, Raju was on board of Satyam. Raju had two sons and they were running Midas. And what they did was, because of very close government contracts, they acquired a lot of land in Hyderabad because they wanted to get into construction business. Now, in order to acquire land, you need money. Where would the money come from? So, what Raju did was, he pledged. And what did he pledge? He pledged his promoter shares. What are promoter shares? The shares that are with the promoter when the company is new, and then when the company goes into public and issues an IPO, the promoter has a significant number of shares. Even today, there are a lot of promoters who have a lot. So Mark Zuckerberg, the Larry Page, and so they have a lot of promoter shareholding even now. So these promoter shares Raju had, but what he did was, he pledged these shares because everybody was so happy about the market, which was booming, and nobody anticipated that one day the market would crash. So the promoter shares were pledged and the money was taken. And with that, huge amount of property was taken, construction started. And then ultimately, what happened? The 2027-28 housing bubble happened in the US. India was still safe to a very great extent because we are very, very conservative as far as loans are concerned. And we don't have this secondary, sub-secondary market for credit. We're very strong on the credit. Even today, you can't get a housing loan in India if you're not a salaried employee, or if you do not have a particular number of the amount coming to your bank account every month. They're very, very rigid. In the US, you had this substandard loans with which you can get loan that, but at a higher credit if your credit score is poor. So what happened? Suddenly the housing bubble crashed, and in India the repercussion was felt. The property market crashed, and suddenly all of these lenders who had lent money to Satyam, they started asking their money back. Satyam was not able to pay because all of that money was blocked, and now the construction business was not booming at all. People were not paying money, so there's no inflow happening, and the interest started getting accrued. So what these lenders started doing, they started selling off the pledged shares. All of these pledged promoter shares, they wanted to sell off. Now, when you would sell off the shares in the market, what would happen, guys? When you sell off the shares in the market, what would happen? Anybody? Suddenly, with no other change, the number of shares, available shares for trading in the market is going up. What would happen? The share price would come down, right? The share prices would come down. In order to prevent that, so that people should not know what has happened, they started fudging their books. They did not want the share prices to show a decline. So they started fudging their books. Initially, it started slow. They started booking revenue, showing debtors. And then they realized that no, we cannot have so many debtors on our records. I don't know what went into whose mind, and I don't know how did the auditors miss it, or probably there was a collusion between the partner and Satyam, I don't know. But what they did was, initially they started booking debtors to revenue, and then they started booking cash to debtors. And actually, they showed a huge amount of cash, physical bank in their books, which did not exist. And PwC did not ask for the verification of that, which is very, very strange. So over a period of time, the gap of window dressing started becoming so huge that a huge proportion of their revenue was fudged. Cash did not exist. The entire books were overdressed. And then, in order to, now this cash is increasing, right? And slowly and steadily, the auditors started becoming cautious and they said, no, we cannot continue anymore. Then, what did Satyam do? In order to show and balance the books, Satyam floated proposition that they would go and acquire Midas. And in order to acquire Midas, they would pay the money. All of this money would have been would have been wrong money, okay? It would have been fudged money because there is no money. But in case if they could show that Midas would have come in their books and they would have given away money to Midas, then all of this bogus cash lying in their bank account, in their balance sheet would go away. But then what happened? All of these minority shares, they started opposing. They said at that point of time, Midas was a very, very bad business, not related in any way to the core business of Satyam, and they didn't want the acquisition to happen. At that point of time, when the acquisition idea fell through, Raju was exposed. He couldn't keep pushing that fudged account. And he owned up. And that letter, that letter is freely available on the net. If you can find out, look for that letter. It is such a sin, like more than 80% of the books were all fudged. And he was caught behind the bars. And in that process, we realized that still the core business that Satyam ran was very good. And then a committee was formed, and then they floated Satyam, and then Tech Mahindra took Satyam, and then the prices went up. But like that, there are so many fraud instances where you will realize that the credit, somewhere the revenue is a very, very big issue, and you cannot go ahead if we have not fixed the revenue recognition criteria. So that brought us to what is revenue recognition. And so if you look at it, there are three things that we're going to talk about. We're going to talk about the overview, so which we've already discussed. Why was there a need for revenue recognition? What happened? What was the surrounding environment which gave rise to the revenue recognition standard? So now we have an objective pathway, and we have very, very clearly said that all of these 5 steps have to be met sequentially, and unless and until they are met, you cannot go and book a P&L credit in your books. Also, we've been very clear about the way the figures should be reflected in your balance sheet. So all of these, because see, ultimately P&L gets close to balance sheet. So we want you to understand that things which we don't allow you to put in the revenue would ideally somewhere or the other sit in the balance sheet, right? You gave me money, and I'm not allowing you to book it as P&L credit. So cash to revenue, I will not let you pass. So if you know that cash to revenue cannot happen, then you know that instead of revenue, there will be unearned revenue, which is a liability. So that is why the balance sheet, how are you going to reflect this liability? That becomes important. So this is the liability side. What about the asset side? If you are booking revenue, but you cannot book cash. So you will either book debtors, or you will understand there's a difference between debtors and contract assets. So what are these contract assets? What are these contract liabilities? And how are you going to report it in your books? That's what we are going to learn today and tomorrow. Okay, anybody, any questions before we start? Is the premise clear? The idea of what is revenue recognition? Why did we actually think about coming up with a standard on revenue recognition? Is this clear? By the way, now you know, after the Satyam fiasco in India, now SEBI has made it compulsory that if the promoter shares are pledging their shares, if the promoters are pledging their shares, and if that is a percentage which is more than 5%, you will have to inform SEBI about it. So any kind, so because suddenly, all of these promoter shares were diluted, but nobody knew about it because there was no information about that going to SEBI and the regulators. So now SEBI has made it mandatory that any dealing with promoter shares have to be made visible by filing the requisite requirement with the SEBI. Okay, so we are going to talk about these 3 things today. So what is revenue recognition and why is it important? One second. So if you see, and this standard has underwent changes. Okay, so the need was felt and we started working on the revenue recognition standard, and then we came up with the new standard. So a new standard in form of accounting standard codification 606 became effective in the year 2018. What we have tried to construct is a single principle based model. See, revenue is such a big area and it is industry specific. There are so many industries, maybe services, maybe goods, B2B sector, B2C sector, that we cannot exactly tell you in every sector, every company, how do you recognize revenue. And the instances of revenue recognition also vary. The reasons when and where the revenue can be recognized is very industry specific. So what we have tried to do is, what when we say we, I'm talking about the accounting profession. What they have tried to do is they have tried to give you a single principle. So principally, these steps have to be followed before you can recognize revenue in your book. So it's a principle-based model which provides all the contracts with customers regardless of which industry. What is a transaction pattern? So I'm giving you some core principles, and all of the tenets of the principles have to be met before any user or before any entity, maybe an individual or a company, can go on and book P&L credit as revenue. The core principle, and it is based on the core principle that you can recognize. Now you know the meaning of the word recognize. Recognize means putting it in your financial statements. It is in your financial statements. Only when an entity satisfies a performance obligation by transferring either a good or a service to the customer. Now we are linking it to the Contract Act that we are going to do if you guys take when we will do regulation, it is compulsory. The part of business law that deals with the Contract Act will have this, right? So we know that there can be a valid contract between two parties when each gives and gets something in return. So there has to be a mutual consent, and each party has to give something and get something in return. So the standard is very clear. You can only put a P&L credit for revenue when you have satisfied your end of the promise. So obligation means a promise, right? So you have promised to do something and you have done your part of the promise. So if it's a good, when do you think you should be ready to recognize revenue in your books? When do you fulfill your part of the promise if you are selling goods? Anybody? If you are selling goods, what is that time or what is that exact moment when you say that you have fulfilled your promise for selling goods? So when you have met so you remember FOB shipment, FOB destination? Yes, very good, Hanuman. The key word is the risk and rewards should have been transferred. When does the risk transferred? In case of an FOB shipment contract, it will be transferred when the goods are loaded to the carrier for the onward journey. And in case of destination contract, it would be when the goods have reached the destination and the seller has tendered delivery. So when the ownership transfers, because the risk and rewards have been transferred. So in case of an FOB shipment contract, everybody knows this, right? Anybody who has any issues in these concepts, please let me know, okay? Because I'm assuming that you would know this. So imagine two different countries and there is a seller. Let's say the seller is based in the US and let's say the buyer is based in Mexico, okay? So the moment the goods reach and there is a lorry which is going to carry the goods, the moment the goods are put on the lorry, immediately, if it's an FOB shipment contract, we say that the risk has passed from the seller to the buyer. Now the goods belong to the buyer. And during the transit, if something happens to this truck and the goods get destroyed, the loss would be of the buyer. So there was a sale from the seller's perspective, and the buyer had a purchase, and then the buyer had loss of goods in transit. The opposite happens in FOB destination. In FOB destination, the seller bears the risk of loss till the goods have reached the destination and the seller has tendered delivery. So we are going to follow the rules of law in order to understand when does one party satisfy their performance obligation. In case of services, the service has to be performed. Then only the recognition criteria is met. So first, only recognize revenue after you have satisfied your performance obligation. You have done your part of the promise. And second, is that the amount of revenue, the figure that you go, so this is the timing of revenue recognition. When do you recognize revenue? And this at what amount? Okay, so at what amount? The amount of revenue recognized is equal to expected consideration the entity is entitled to receive in exchange for the goods or services provided. So here, can you understand? We are not linking it to the contract signed. We are not linking it to what the people have agreed to. We are linking it to what is the figure that you are reasonably expected to get after having performed your obligation. Now, I have a question. Please answer it after thinking. Let's say I am into a works contract. So I go and I build boilers at various factories. And so it's something that you have to go and then you have to build at a client's place. So when I'm building a boiler, the terms of the contract says that the consideration is 1,000. So let's say $10,000. If you are able to do it in less time than you have said, then I'm going to give you an extra 5% bonus. If you're going to give it on time, I'm not going to give you any bonus. Your history says that you generally finish your work before time. Now tell me, when you recognize revenue, what amount you should be recognizing? Should you be recognizing 10,000 or should you be recognizing 10,500 with the bonus? What do you say? And let's say the contract takes around 2 years' time to finish. When you recognize the revenue, would you recognize the figure 10,000 or would you recognize it with the bonus? Okay, so we have one student who says without the bonus, one student who says with the bonus. What are the others doing? Guys, please answer. Okay, please answer. So, Vishi, it is so good to see you in our live class. Okay, see, Hanuman, unmute yourself. When you say it should be without the bonus, what is your logic?
It is not actually received or not received any confirmation from the uh,
Hmm.
party that he is going to pay. At least we should have some evidence to book the revenue.
So you're trying to say that we know we are conservative.
Yeah,
So we should not be, and this is a gain. So we should not recognize the gain beforehand unless and until either we have a claim to that gain or we have some
yes.
kind of a statement to substantiate that gain. Is that
At
correct?
least we should both, yeah, agree that we have completed on time and we will get the bonus.
Okay. And what about you, Subhashi? Why do you say that you should book it with the bonus? Why should you say that?
Ma'am, because it is expected consideration, so we are expect, and our trend says that we always finish before time. So expectedly, this time also we'll finish before time. So that's why we should book with bonus.
Yeah. So if you look at the standard, guys, they're very, very clear. This is the only place where we want you to be as near to practical world as possible. We are not going to be very rigid about the conservatism. We are going to ask you. So you are the person who has to substantiate that. Do you think it is reasonable to expect that bonus? And if you can say yes, over the last 10 years that I've been in existence, out of 100%, 99% of the contract, I've got the bonus. So they are saying when you are booking the revenue in your books, make it as near to the amount that you are rationally expecting to receive from the other party. I am allowing you here to not go by the extreme concept of conservatism that I generally ask you. For revenue, you tell me according to the industry standard and according to your performance, how much revenue are you going to rationally get from the other party? So, in my example, you are actually going to book a revenue of 10,500. Why? Because your history says that you're going to get so much from the other party. Is this clear? So, logically, if you look at the accounting history, we are conservative. But this is one of the areas where we have linked the amount of revenue to be booked to the amount that you're rationally expecting from the other party. Why? Because we don't want the books to go up and down all the time. We don't want that to happen. And revenue is such an important factor, because if you realize, every analyst who's going to look at your accounts, he or she is going to first figure out what is the CAGR, the compounded annual growth rate of revenue. From that revenue, we are going to devise a lot of other extrapolations. Our turnover ratios are all based on revenue. Our COGS all based on revenue. So everybody who's going to use the extrapolated financial statements, and they're going to do the trend analysis and the common size statements, revenue plays a very important role. So I don't want you to be conservative here. I want you to be rational, and you have to substantiate why did you expect to get that bonus. So see, many companies may not be booking it because they want to be conservative and they want to wait. But if you look at the verbatim of the standard, they're very, very clear. Whatever you're rationally expecting to get from the other party, which if it includes bonus, so this falls under the category of variable consideration. You will be allowed to pre-book this amount. Okay, so you've got the premise right? So first, don't book anything till the time you have fulfilled your part of the promise. So you have to earn. So there's a word in accounting which we term as earn. You have to earn that revenue. That's number one. And second, don't book an amount above or below what you're expecting to get. So link it to the real world expectation. Even if you have to pre-book some additional revenue, which is okay, because this is the amount that you can substantiate and tell me, why did you rationally expect to get this amount? So if you're expecting bonus, include that bonus as a part of the revenue. Don't wait till you get that bonus. Okay. There are specific standards which relates to leases or derivatives, instruments or non-monetary exchanges. For those items, go to those standards. A generalized revenue recognition standard will not cover all of these special scenarios. Okay, so we've already spoken about Enron, we've already spoken about Satyam. The idea is to let you know what could be the fiasco if revenue is not booked rationally. Dharini, either you unmute yourself because I'm not able to understand your question. I'll find expected value when will constraint. Yeah, when you have various probabilities, we will figure out expected value, but we're going to get to that. And I did not understand what you meant by when will constraint. I'm not able to understand that. Okay. So either you phrase your question a little better or you have to unmute. But yeah, there are concepts of expected figures, which we are going to talk about when we go to the question. Okay, so I'm now just, get into the shoes of somebody who's actually making this standard. Okay, so imagine you were the person and you were told, let's see, Enron has happened, Satyam has happened. And before that, they saw Toshiba, WorldCom, there were so many frauds that happened. Now, if you were to make that standard, which would prevent all of these fraud and give something in the hands of the auditors to come up and say you have not recognized revenue properly, so give them a law by which they can threadbare analyze the revenue recognition objectively and tell the companies or the entities that no, you are wrong. And you're wrong because the law says you have to do this, you have not done this. So how do you do that? So we said, see, every entity has a two-way obligation with a customer. If I am wanting to, so if I'm in the business of providing you training, my job is to give you training and your job is to pay me. So it's either a good or a service that one entity will get to the other entity, and in return, the other entity would pay the first entity. What were the issues? The issues was when to recognize revenue. So most of you have paid me before coming to the class. And there are people who've paid me for all the 4 courses in advance. Can I book the money immediately on getting it and say that this is my revenue? The answer is, okay, go to the principles based model. Did you earn that revenue? The answer is no. Tomorrow, for some reason, if I'm not able to take the class, I have to repay the money back to you, right? So we say, no, I have not completed the revenue. So the revenue earning process is not complete. Why? Because I have not performed my part of the promise. So I have not satisfied a performance obligation. So I cannot recognize revenue in your books. So what entry will I pass in my books? Wait, Tadani, I'll take your question. What entry will I pass in my books? Can you tell me? when you pay me the money, and many of you have paid me in advance, right? So what entry will I pass? I will get the money in my books. So I have to book bank, but I cannot credit revenue. So what will I do? I'll create a liability in my books and I'll call it unearned revenue. In India, we used to refer this figure as pre-received revenue or deferred revenue, whatever you call it. So you can call it pre-received income. Now, this is a term that we don't often use in the US, or there's another term that you call, which is deferred revenue. It's all the same thing. What you have to understand is all of these are liability accounts. These are not P&L credit. And you know P&L credit is actually good news, but a liability is bad news, right? So what do? I get that money. I pass it through the sieve of the principals. Have I earned the money? The answer is no. When do I earn the money, guys? In my example, when do I earn the money? When do I earn the money in my example? Once the classes are given, once the training happens, that is the time. So I need not wait for the entire, yeah, very good, Dharini. The key word is over a period of time. Yes, every time when a particular section is completed, we will book the revenue. You know, there was this company called Byju's in India, which got a huge funding from Disney, and they started floating their courses. And there was a very big audit query that came up because they were booking revenue. So they were booking 3 year subscription and they were booking the entire revenue in the first year itself, which is wrong because if you have to deliver something over a period of 3 years, you cannot book 3 years revenue all in one at the time of receipt. That's incorrect. And that was a big query that came, and the auditors refused to sign their papers. So please remember, both the parties, before they recognize revenue in their books, the seller has to provide the good or the service. Before that, they cannot book the revenue in their books. Before that, if you get the money, you will have to book it as a liability, which is unearned revenue in your books. And then later on, when I complete the earn, so when I give you, so let's say you've paid me for 4 sections. In our business, we generally don't have to defer it till next year because this is all supposed to be consumed within one accounting cycle. So accounting standard gives you this leeway. They say that, see, if throughout the year you're going to consume the product, if you're going to get the money and if you're going to use it within one operating cycle, we would not allow you the hassle of pre-booking revenue and then splitting it into different years. You can't just book it in the same year if your accounting cycle is less than a year. So now when I give you the classes, let's say 1/4 I can get when I complete the first level of lectures. Then what revenue should I pass in? Then what entry should I pass in my books, guys? See, revenue recognition is all about J's. Pay very, very close attention to J's when you're doing revenue recognition. 10 to 1, when you get a question, they will ask you to do J's in revenue recognition. So what entry will you pass? You will, so first entry was bank and to unearned revenue. And then when I provide the training, I'm going to remove that liability from my books. So unearned revenue will get debited and I'll credit the revenue in my books. So this is the sales account. Okay. So when to recognize revenue? That is the first question that we need to know. So when the earnings process is complete, how much to recognize? So in case of Byju's, when they took 3 year subscription in year one, they cannot book the entire revenue in year one itself. At the end of year one, they can book 1/3 of revenue, assuming that the classes have evenly happened in each of these 3 years. So how much to recognize? At what time do you put the credit in your P&L? That is when to recognize. And how are you going to show? So if you're going to show these unearned revenue, and if there are assets, how are you going to show it in your balance sheet? So these are the 3 questions we've got to ask yourself. When, how, and how to represent the books. Okay. So we came up with a 5-step model. We said, see, when, what figure, and how to show it in the balance sheet. Let us threadbare, zoom in and understand each of the 5 steps. And if you have sequentially fulfilled each of these 5 steps, you could go ahead and book the revenue in your books. Now, before I'm going to, get into this, I'm going to ask you some questions, okay? And what we are going to do is we're going to keep those questions hanging, and hopefully by today and tomorrow, we should be able to arrive at the answers to those questions, okay? So assume that I'm going and buying an AC, okay? Now, an air conditioner. Now, in the US, I really don't know how does the air conditioner sale and what are the terms. In India, I'm saying what happens. Air conditioner comes with a compressor, and the compressor warranty is for a longer period of time than the warranty that is coming with the AC per se. So I go to a particular shop and I want to buy. So I go to a dealer and I want to buy an AC. So this guy tells me that, see, you can buy an AC. The price of the AC, let's assume for simplicity, is 55,000 INR. And they say that along with that AC, I will give you a 1 year warranty. So anything that happens to that AC in a period of 1 year, I will repair it free of cost from you. And this will also come with 5 years compressor warranty. I think it's 5 years or 3 years. The compressor warranty comes for 3 years or 5 years. A copper compressor, if there is, then the warranty would be for whatever. It's 3 years. Let's simplicity call it 3 years. So that AC is going to come up at 55,000, with which there will be a 1 year warranty and there would be a three. So both of these warranties would be there. Also, I'm telling you that you can also buy a 2 year additional warranty from me. And this 2 years additional warranty, I generally sell it at 5,000 each year, which is 10,000. But because you're buying the AC with me right now, AC from me, I am going to give it to you at a discounted 50% discount rate. So you pay me 5,000, and with 60,000 INR, you will manage to get an AC with 3 years complete warranty, because 3 years compressor was anyways there. The earlier warranty was for 1 year, but you've got now additional 2 years. So years 2 and 3 also you got the warranty. So for 60,000, you're going to get the AC and free services for the next 3 years. Is the example clear to everybody? Now tell me, I am the seller. How much revenue should the seller recognize? What are the entries in the books of the seller? Can anybody tell me? What would be the entries in the books of the seller? Can anybody tell me? How much revenue should you be recognizing? Just break it down. How much revenue should I be recognizing at the time of getting the money from? So I know I've got how much? I know I've got $60,000. So bank definitely comes 60. What about the credit? How much revenue should I be allowed to book? Can anybody tell me? How much revenue should I be allowed to book? Subhashi, unmute yourself. Tell me the question. How would you do it?
Ma'am, it's for 1 year. This year we will book. So 55,000 already we got because the sale is completed. And for the warranty pertaining to this year, because we purchased at 5,000, so that was for 2 years. But for
No. So this 2 years will start at the end of year one, right? So see, this is the year of sale, year one. 1 second. This is year two and this is year three. So this is, let's say, first day of the year, the sale happened. Okay. Now 1 year warranty is free. 1 year warranty is free. Is that clear?
okay,
Free means it would come. And year two and year three you have bought. And for that, you've got a 50% discount. And that is why you have paid this much. Is this clear?
yeah, then only 55 then for now.
Okay. What is the logic? And so tell me, what is the revenue that I should be booking in year one, in year two, and in year three? Tell me that.
Year 155, year 2, that half to 2.5, and year 3 also 2.5.
Okay. Does everybody agree? Does everybody agree to what she's saying? Anybody who has a different opinion? Hanuman said the same thing, right? Yeah. So typically what we are saying that what about this revenue? Why this warranty you did not account for separately? Why this? So there is a reason. Can you understand? These two warranties are different. Okay. I will not answer this question now. We will go through the 5-step model and then we will come back and answer this question. Okay. So that's the first scenario. The second scenario is 5,000 each year. Dharani, unmute. Okay, you cannot unmute. When you say 5,000 each year, how much is the total money that you're talking about? So everybody agrees that this year should be 50, next year should be 25, and third year would be 25. This is what most of you guys are agreeing, right? We'll talk about it, okay? I'll give you another case study. So this was case study 1, okay? The other case study says, let's say I'm buying, and hypothetical, okay? This is not real. And let's just take an hypothetical scenario. I'm buying a Dell laptop, and that Dell laptop is, okay, no, let's not say Dell laptop. A washing machine. What is a warranty for washing machines in India? Anybody? It's still 1 year, right? With the compressor warranty of 10 years, if I'm not wrong. Let's just take a washing machine. Motor is for 10 years, but otherwise, so I'm just hypothetically restating this, okay? So my second example is, let's say, and this is an hypothetical example. So my case study 2 says, let's say that I'm buying a washing machine, and that washing machine is coming with a warranty of 2 years. Warranty of 2 years. So today I'm going to sell that machine to you for, let's say, 60,000, and this 60,000 is coming with a implied warranty of 2 years. Okay? And the amount of revenue that you could book, let's say I look at the warranty estimates and I can put a figure to that warranty. The question is, the warranty would run for 2 years and people would come in year 2 and ask for money. So let's say I sell off 60,000. I sold 10 machines for 60,000 this year. So I got $600,000. In year 1, there were some people who came up and I had to change their parts without getting any money. Let's say that changed part was $2,000. And in year 2, some people came and let's say they wanted $5,000 worth of warranty replacement. My question is, what are the journal entries that the company is going to pass in years 1 and in years 2? In this case, am I going to split this 60,000 into the cost of the machine plus the warranty? Yes, no. What do you guys say? Are you guys with me till here, or are you getting a little lost in your mind? Are everybody with me till now? Is the question clear? I have given you a washing machine. I have owned up to take a 2 years warranty. There are warranty claims coming in year 2 and warranty claims coming in year 1 and in year 2. You pay me 60,000 rupees all in year 1. What do I do? What is the amount? Yeah, very, very good, Dharani. Yeah, very, very nice. Yeah. But can you give me the logic? Yeah, what you're telling me is true, but can you give me the logic? Guys, can you tell me the difference between warranty, 1 year warranty, and this 2 year extended warranty here? Anybody, can you put it down in words for me? So there are 2 kinds of warranty. Can you see? The first kind is implied and comes with the product, and you cannot buy it separately. The other kind is an option to you, and the company can sell it separately. A washing machine cannot be sold without a warranty. An AC cannot be sold without a 1 year warranty. Nobody can sell a 1 year warranty for AC for the first year separately. So as a product, you don't have 2 separate promises. Okay. So with this in the background, let's start the 5-step model.